Hello and welcome to another Fresh Thinking by Stone Optero podcast. Today I'm joined by Julian Aldridge, our managing consultant in the EMEA region. My name is Laurie Hassall, and today's topic is what do private companies consider to be important versus CRIRSCO Code compliance for publicly listed. So a big title, but I think quite an important one actually, because we deal with a mixture of, as a consultancy, deal with a mixture of companies, and some of which are privately listed, some of which are private, some of which are publicly listed. And I think it's important to break down the differences in terms of what might be important for a public company versus what might be important for a private company.
Well, the major difference is management of risk. Management of technical and financial risk. A private company's main objective is to maximize economic returns and to effectively manage financial and technical risk throughout the process. Key drivers for them are things like NPV, IRR, the other sort of financial metrics, minimizing their payback period, and essentially efficiently using capital, having a strong financing strategy, possibly that they can change very rapidly, and then maximizing value if they're looking to sell the asset rather than develop it. So for them, internal studies are decision-making tools. Whereas if you have a CRIRSCO code, the primary objectives for them are transparency, looking at materiality, and making sure that each of the markets gets a balanced disclosure. So it's the key driver there is investor protection, ensuring that the reporting is standardized, and that essentially the resource or the reserve complies to the principle of RPEE, which is reasonable prospects of eventual extraction, and that behind that there is technical defensibility. So for them, a study, rather than being a decision-making tool, whilst it is a decision-making tool, it's also quite often primarily a disclosure tool.
Sure. Okay, and in terms of economic assumptions, how do they how are they handled between what are the differences between private and public companies?
Okay, I mean it depends on the purpose. I mean, the private companies tend to use sort of internal long-term price decks, which can be a lot more, let's say, optimistic than than some of the ones that are than the pricing that's used in for publicly traded companies or under the CRIRSCO umbrella. They can look at using different discount rates. They don't necessarily have to use one that's realistic, and they can look at different project finance scenarios. Things like they focus on internal rate of return, cash flow. They often look at payback scenarios, and the main thing is that they put together multiple models and say, okay, each of these can be considered to be equally valid. We've got these various different options. Whereas under the CRIRSCO umbrella, you've got to use reasonable, justifiable assumptions. You've got to clearly state your metal prices, transparent cost assumptions.
It's transparency, isn't it?
It's transparency, and you've got to put forward what's material. The other issue with it is, or at least the limitation, is that you have to put forward one model, one method by which you're going forward, and that is considered to be the method for going forwards. Whereas a private company has the flexibility to say, okay, so we can put 3, 5, 10 different potential methods going forward.
Okay, so that's economics. So in the world of, and in terms of resource and reserve classification, how does that differ? In terms of private and public companies, what do you see some of the major differences?
Yeah, I mean, private companies do not have the requirement for quoting resources and reserves,
Yeah.
essentially to at the classification that the CRIRSCO Code is used. Yeah. They can treat any resource as mineable without doing any conversion to reserve. They can include upside exploration potential, and they can also extrapolate away from known areas.
But you still see you see private companies that do conform to CRIRSCO compliant.
Oh yeah.
Isn't to say that they don't, but
no. Yeah. The CRIRSCO codes are very, very good at managing risk and managing visibility for investors. So often private investors are very, very keen to see to adopt NI 43-101 or JORC, or whichever of the codes that have the level of comfort that they like for their investment. But yeah, you do have a lot more flexibility. If your company, as a private company, has a bigger appetite for risk, you can adopt that risk without necessarily having to jump through the statutory hoops that are required under the codes.
Yeah. And I mean that leads on, I guess, to some documentation sign-off requirements. I'm guessing, to private companies, that there is no formal, documentation sign-off that is required. However,
no. Often their lenders or their finance groups request it.
Yes.
But it just depends, where their money's coming from.
Yeah.
If it's a private enterprise, they possibly don't have to do it. But if it's a private equity group, the group will often demand the same level of sort of reporting rigor that they do in terms of technical rigor. So yeah, I mean, it's often it depends. I mean, things can pass via board approval without necessarily having to have any sort of reporting code compliance. I think the other thing that's quite key with this is that their reporting can remain confidential.
Yes.
There's no requirement for them to go to the market or report to the market what they have or what they don't have.
Difference.
Yeah. They can also cherry pick. They can go to the market and say, wow, look at what we've got here, rather than having to release every intercept that they've done or, give a full rigorous assessment of every stage of work. So they don't have to deal with those tranches of work where you don't find anything. They essentially kill an area.
So we've talked about the differences. So are there best practice areas where private and publicly funded finance companies agree?
Yes, I think yes is the short answer. They tend to agree on geological and technical and engineering rigor. There really is no substitute for those, and yet they tend to ensure that their mine design is technically optimal or technically reasonable. Their costs tend to be realistic. There's quite a lot of overlap. I mean, if you had a Venn diagram of the behavior of private companies and public companies in terms of the technical side, there would be a huge overlap area in between them.
I think there's almost an expectation, isn't there, that even if you're a private company, there is a certain level of expectation from lenders, finances that you have hit the standards that are set by CRIRSCO, and
they are an excellent guide. They are an excellent guide. But I think if you're a private company, you don't necessarily have to feel that your hands are tied by being compliant with them. Another one that another area that I wanted to mention was implementation of ESG considerations. I mean, these are something that are coming into the new iterations of the codes, and they are something that are certainly going to be coming in as cost line items and delivery line items, even at a bare minimum, because these are something that have implications on the viability of a project, and therefore feed back to this idea of reasonable prospects of economic extraction.
Yeah.
And a demonstration of economic viability.
Yeah.
So that's something that the private companies have perhaps, they have had to think about less, and
slower to adopt, I guess.
Yeah.
So just wrapping up then, Julian. So how do the differences affect project development?
Well, if you just to put it simply, I mean, for private companies, project development and becoming operating a mine is about making money. The idea of for public companies reporting under the code, it's preventing investors from being misled. There's the history of mining is littered with examples of times and companies where investors have been misled. So obviously that's very important. However, this is one of the main differences between how a private company can operate and a code-compliant, publicly traded company. The differences don't just affect their reporting or their output. They shape how projects get designed and financed and de-risked. Private companies can have multiple different models, multiple different options they're looking at. They can optimize the different ways, the particular payback period. If you've got a private equity group who want their money back as soon as they can, they're more likely to sort of design for staged expansion. And they can use, if they've got an appetite for risk, they can use assumptions far more, which can speed up project development.
Sure.
Public companies tend to have more of a focus on classification, resource and reserve classification, and demonstrated modifying factors. By the point you get to the pointy end of project development, you really need to have an understanding to within plus or minus 10% or 10 to 15% of your costs and your timeframes. And you don't tend to have that opportunity to save time by just adding in assumptions.
Yeah. Okay.
So, yeah.
All right. Well, thank you very much for that, Julian. That was an interesting topic, one that's I don't think ever been covered before, and good to delve into the differences in terms of project development between private companies and public companies. So, thank you very much, Julian.
Brilliant. Thank you.
We'll see you on the next podcast.